One of the key reasons for stock market to fall or rise is the earnings growth of its stocks. So in this video, I'm going to discuss 5 to 6 companies where the earnings growth has been excellent in the last few quarters. Just a disclaimer that these companies are not buy or sell recommendations, as anyways I'm not doing the full deep dive analysis here. So please take this video only for educational purposes. Now before I start, a very big announcement. I've launched my brand new Hindi podcast channel called Good to Great. On this channel, you are going to listen to guests from all streams including finance, sports, fitness, all in Hindi. And the best part about this channel is going to be that if you have a story to tell to the world, then you can appear on this channel as a guest. Simply go to this channel, subscribe to this channel and wait for further announcement to happen on this channel. I'm eagerly waiting for your support. With that, let me come back to our main topic, which is discussing 5 to 6 companies where the earnings growth have been excellent. The first company that I'm going to discuss is Lupin, which is a pharma company. Now, I'm not going to go into details of what this company does, but if you look at the recently quarterly results of this company, what you will note is that the top line of the company has grown by around 26% year-on-year basis. If you look at the EBITDA, around 62% growth rate YOY basis. If you look at the net income or the profit after tax, 38% of the growth YOY basis. If you look at the segmental wise performance, then North America, which is their largest business segment, that has grown by around 52% year on year. So overall, very good growth rate. Their API business has been down 24% degrowth, and that's what we have seen in pharma companies a lot, that the API businesses have been down. But if I talk about the company's last few quarters, if you look at, let's say, last 5 quarters, look at the sales number and look at the EBITDA margin in terms of the trend here. So sales have been going up continuously, but Q2 and Q3 have been quite outstanding if you compare the 5 quarters, right? You can see the numbers here yourself. And if you look at the EBITDA margin of this company, they have expanded, right? It used to be 24.3% back in Q3 FY25. It's gone to now 31.1%. Now, can they sustain these EBITDA margins? I don't know. That is for future. And of course, I'm not doing deep dive analysis here to look at what their future outlook is. I'm just going to talk about the past performance of this company as of now. Now, coming to the 9 months performance of this company, if you look at on 9 months basis, the net sales have gone up by around 20%, which is very healthy in my view. If you look at the net income, which is the profit after tax, around 54.3% year-on-year growth. So far FY26 for Lupin has been very good in terms of the P&L. Now, if you look at this company's capex, you will note that the last 5 quarters, the company has been doing a lot of capex. In fact, Q2 FY26 was the highest in terms of capex, 3474 million in INR. Net debt to equity is in minus, actually 0.14, which means it's totally debt-free company. Now, of course, you can go and explore what are the risks in this particular company, because I have not talked about the headwinds that this company might be facing. But if I look at the valuations very quickly, currently it is trading at around 20 PE and the PEG ratio of this company is 0.35. Now, this low PEG ratio means that the earnings growth is very high as compared to the PE ratio, because PEG is what? PE divided by the earnings growth rate. Since the company is delivering very high earnings growth rate, the PE has compressed and also the PEG ratio is very low. The moment earnings growth stops or earnings growth is not there, PE might shoot up. This is how you got to look at the PE ratio as well, in the context that why it is low, because the earnings growth is very high as of now. Now, if I talk about the past trend of this company, and if you look at the PE ratio, how this has contracted. So it used to be at around 108 back in July 2023 because the earnings were not there. As you can see, the earnings per ratio here, these bars are down, right? Since the earnings growth started to go up, the PE started to contract, and that's the logic essentially I was trying to sort of explain to you. It's at around 20 now. If you look at the EV multiples, that is also contracted. It's at around 13.1 as compared to median of 21.1. And if you look at the price to book ratio as well, it is slightly elevated than the median one. So median has been 4.2 in the last 5 years. It is slightly elevated as of now, 5.2. But overall, the company has delivered very good earnings growth rate. But please go and do some deep dive analysis of Lupin so that you understand what does this company do, where are the headwinds, where are the tailwinds, and you do complete analysis before you take any investment bets. Here, my intent was to bring you some insights about their recent earnings growth rate as well as their sales growth rate. And if you like that, request you to hit the like button. Let me know in the comments a simple thank you. It motivates me to bring such content to you at zero cost. With that, let's move to company number 2. The second company that I'm going to pick is from real estate sector, a company that all of us know, DLF Limited. If you look at the recent quarterly performance of DLF, in Q3 FY26, they have delivered a PAT of around 1252 crores, which is 29% higher year-on-year basis. This is before exceptional item. So if you look at their P&L account, you will find that in Q3 FY26, they had around 45 crores of exceptional item, which have taken their PAT slightly down. Overall PAT is only 14% if you remove this exceptional items. But to be honest, that is one-off, and that's why company is delivering both these numbers, which is before exceptional item or after exceptional item. Now, if you look at the last 3 to 4 years of growth rate for DLF, from a revenue perspective, if you look at it, FY3, FY24, FY25, steady growth rate in their revenues have been there. 9 months FY26, if you compare, so the green here you see 7722 crore versus 5649 crore is giving you 9 months of comparison between FY25 and FY26. Okay, from that comparison perspective, still 9 months have been very, very good from a revenue growth perspective, from EBITDA perspective as well, and from a PAT perspective as well. If you can see overall, there has been a growth. Now, DLF has two entities, DLF Limited, DCCDL, which I'm not going into details here, but I'm going to talk about DLF numbers as such. Now, if I show you the valuations of DLF as of now, and if you look at the PE ratio of the DLF, it has contracted massively. It used to be at around 94. It has come down to almost like 37 when I'm recording this video. If you look at the EV multiples, that used to be almost 101. It's now contracted to almost 44 at the time of recording this video. And if you look at the price to book as well, it's come down from 6 to almost median, which is around 3.7. So why there has been contraction in the valuations? See, one of the reasons that you need to know about DLF is this data point here, which is the bookings, new sales booking. Okay. So if you look at the last 9 months of FY26, how much of new sales booking they have got? 16,176 crores, right? Previous year, if you go back, FY25, 9 months new sales booking was how much? 19,000 crore, 19,187 to be precise. So there has been a decline in the new sales booking in the last 9 months. And this is where the market is spooking about when it comes to the real estate businesses, because there is a fear about real estate businesses slowing down in India, especially the low entry or the entry ticket size is, let's say, 70-80 lakh rupees. That's where the market is slowing down definitely. This is a risk that you need to note. I don't know how the real estate market will play out in the next few years or quarters, but as of now, that's the picture about DLF. Go and explore, for example, companies like Lodha, for example, Brigade Enterprises, Oberoi Realty. I've talked about some of these companies in a previous video on real estate sector. If you want to explore real estate sector, go and watch that video. That is going to help you. But so far, DLF in 9 months have shown good growth rate from a PAT perspective. I don't know what the future will look like, so don't take this as a recommendation. With that, let's go to stock number 3 now. Third company that I want to speak about is from banking sector, State Bank of India. Have a look at how State Bank of India has been performing in Q3 FY26. Highest ever quarterly net profit of around 21,000 crore with a year-on-year growth of 25%, almost 25% growth rate. You can read the numbers here. And more importantly, if you look at SBI's credit growth rate, it's up 15.14% year-on-year. This is a very, very good growth rate in credit. And what it is telling me is that underneath of banking sector, the Indian economy seems to be picking up, because if banks like SBI is doing well from a credit growth rate perspective, chances are that economy is doing pretty well in Q3. Now, if we dig deeper slightly in their P&L account, couple of red flags. Net interest margin have been down 2 basis point and 3 basis point, while credit cost also has been up around 5 basis point. However, the good thing is the gross NPAs and net NPAs have come down massively. 50 basis point down gross NPAs and net NPAs down by almost 14 basis point. Return on assets for this bank has been very, very good. It has gone up by around 7 basis points, around 1.16. How about last 9 months? If you look at the last 9 months performance in FY26 versus the previous year, company's profits have grown by around 15.48% cumulatively, which is very, very good. Again, from a NIMS perspective, there has been a contraction here, 17 basis point, whole bank level as well as domestic level. That potentially is a red signal for investors. Now, if you look at SBI's valuations, price to book of this company is now trading at around 1.9 when I am recording this video. Last 5 years, median has been around 1.5. So this have been re-rated in my view, right? Because maybe the profits have been very, very good. That's how the market is looking at it. Again, not a recommendation here that you go and buy slightly the higher valuations is what we are seeing, maybe because the profitability has been on the higher side and there has been some bold statements made by the chairman of State Bank of India. Go and listen to his interviews as well. You will come to know how the overall industry is doing and the economy is doing and how the bank is reading the industry's growth. With that, let's move to company number 4. And this company is from hospitals, Apollo Hospital. Have a look at Q3 performance of Apollo Hospitals. The company's consolidated revenues have grown up by around 17% year-on-year basis. Their EBITDA has gone up by around 27% year-on-year basis, and their PAT has gone up by around 35% year-on-year basis. This is a very, very good growth rate that we have seen in Q3 FY26. What about 9 months of FY26? Have a look at this data here. And what you note is the consolidated sales have gone up by around 15%, slightly lower than the Q3 performance. If you look at EBITDA, around 22% growth YOY basis, and if you look at the PAT, around 34% year-on-year basis. So clearly Q3 has been a better quarter for Apollo Hospitals as compared to 9 months, but overall 9 months performance has been rock solid for Apollo Healthcare. Now in terms of the valuations of Apollo Hospitals, if you look at the PE ratio has been coming down consistently. It is now at around 60. Median has been around 86 in the last 5 years. We know that hospitals have been trading at very, very high PE multiples. Price to book, if you look at, it's at around 12 at the time of recording this video. Median in the last 5 years has been around 12.9. And if you look at the EV multiples as well, it's been around at, let's say, 30, almost 30 at the time of recording this video. Median has been around 35. So there have been some valuation corrections in the hospital themes. Again, go and explore, look at this particular theme. There is a new index as well, BSE Hospital Index. Go and explore that as well. You will learn a lot about hospitals. In the interest of time, let's move to stock number 5 now. Next company is from auto sector, Eicher Motors. If you look at Eicher Motors Q3 FY26 results, total volumes, because in auto we look at volumes first, 21% up, okay, year-on-year basis. If you look at the revenues from operations, up by around 22.9%, EBITDA 29.6% up, PAT is also 21.4% of growth rate. If you look at the last 9 months, okay, the 9 months numbers are looking extremely good here, okay. Although there is one more quarter to go, but they're looking like FY24 numbers already. 912, 914 in terms of the sales volume. If you look at the total revenues here, 16,535 crore, 17,327 crore. It's already exceeded the FY24 number just in the 9 months. If you look at the profit after tax here, 4,000 crore in FY24. In 9 months of FY26, it's already crossed 4,000 crores. By the time we get their last quarterly number, it's going to cross definitely FY25 and it's going to show some healthy growth rate in Eicher Motors. Now, if you look at the valuations of Eicher Motors, if you look at the PE multiples, last 5 years median has been 34.9. It is now stacking at around 40.7, slightly elevated. One of the reason, of course, is that if you look at the growth rate, the turnaround the company has seen from FY22 onwards. See how the sales have been dropping up until FY22. And then from FY22, the sales have gone up drastically. And the same is the story with profits. They were coming down from FY19 to FY22, right? From 2220 crores to 1676 crores. And then there is a turnaround from 1676 to almost now 4050 crores just in the 9 months. That's why you will see valuations as well coming down and then going back up. Of course, the earnings have played a role into it. If you look at the EV multiples as well, slightly elevated from median 28, okay, as compared to 23 last 5 years. And if you look at the price to book, it is again very elevated right now, 9.9 versus median of 7.0. So definitely valuations do look elevated from their median last 5 years, etc. But the growth has been there in the company. The question is that can this company sustain these revenue growth rate and profitability growth rate? If they can, then that's okay. But if they can't, there is a possible valuation corrections that may happen, and that's what you need to go and look out for. With this, let me also try and cover one more stock so that you get a complete rounded picture from one more sector. The sixth company that I want to cover is Titan, okay, from jewelry and lifestyle segment. And what you note here is that their Q3 revenues have gone up by around 43%. Phenomenal growth in Q3. If you look at the EBIT has gone up by around 63%, and their EBIT margin has also expanded by 155 basis points. Now, if you look at the last 9 months of performance, total sales of the company has gone up by around 33%. Their EBIT has gone up by around 54%, and the margins have expanded by 188 basis points. Overall, Q3 has been an outstanding quarter. Why do I say that? If I show you the trend of the last few quarters, in fact, if you look at the last almost 11 to 12 quarters, 11 quarters here, and if you see in terms of the quarterly performance of the sales, If you look at the income here, Q3 clearly 24,592 crores of revenues. Very, very huge growth rate in Q3 FY26 versus the last 10 quarters that you see here. And also if you look at their PAT margin has expanded now to 6.8%. Back in FY25, the margin were down for 5.2%, 5.8%. It's now going up to around 6.8%, which is very, very good. Because if you go back to FY24, the company used to report around 8.5% of PAT margin. Can it go back to that sort of level is the question. Clearly, the last couple of quarters have been very, very good for Titan, and therefore you can see that huge growth rate in their PAT, etc. If I talk about the valuations of this company, if you look at the PE ratio of the company, it has contracted hugely in the last 5 years from crazy PE of 177, 166 to now almost at around 76. It is still a very, very high multiple. Okay. If you look at the EV multiples, it has come down to almost 45 now. It used to be back in like 2021, 101. Crazy EV multiples. It's come down, still very, very high. If you look at the price to book ratio, it's now trading at around 29. Median has been around 26, so slightly elevated than median because the last quarter has been very, very good for them. Can they sustain this growth rate? Again, we don't know. There could be headwinds as well. You have to do the deep dive analysis. Here, for these 6 stocks from 6 different sectors, I've just scratched the surface. Okay, I've given you something that you can start working with, start looking deep into these companies and look for your opportunities. By no means I'm giving you any buy or sell recommendations here. Purely I've talked about their fundamentals, which is their earnings growth rate, their sales growth rate. And if you like this type of content, request you to hit the like button. Let me know in the comments a simple thank you. It motivates me a lot to bring such content to you at zero cost. Also, about these 6 companies, if you know any potential risks, headwinds, do share that in the comments. Any views that you want to express, do share them in the comments, because as a community, we can grow together, learn from each other if you've done some homework. Lastly, do not forget to subscribe to my new Hindi podcast channel, Good to Great. The link is in the comments. Go and subscribe and get a chance to come onto this channel as a guest, share your learnings, share your life journey so far. I'll be thrilled to welcome you. With that, I'm going to see you in my next video. Until then, keep rocking.